Hey everyone, welcome back. Ready for another deep dive?
Always.
Awesome. Today we're diving into the world of ETFs with a
Yes.
CPA, Mark Rusin. Now he's not a financial advisor,
Right.
but he's got some pretty strong opinions on which ETFs are the best, or at least the best for him.
Yeah, yeah.
So we thought we'd take a look at his top 5 picks,
Uh-huh.
see how they perform, the fees, all that good stuff.
That sounds great.
And maybe you'll find some inspiration for your own portfolio. Who knows, right?
Always good to explore different options.
Exactly, exactly. So let's jump right in.
Right.
Mark starts off by, well, he doesn't start off great with the ARK Innovation ETF.
Oh.
ARK, yeah. He ranks it as his least favorite, even calls it a one-hit wonder,
Wow.
which, I mean, that's kind of harsh, right?
Yeah, a little bit.
For those who aren't familiar, this ETF's all about disruptive innovation. It's run by Cathie Wood.
Right.
Big names like Tesla and Roku, Coinbase, all those companies pushing the boundaries.
I see. So what's his beef with it then?
Yeah. What makes him so hesitant?
Well, ARKK, well, it's had a pretty wild ride, hasn't it? Like surging over 205% back in,
From 2020, yeah.
yeah, March 2020 to like February 2021.
Mm-hmm.
But then plunge, nearly 60% since then.
Oh, wow.
So you see the thing with ARKK's holdings is they're like high growth, high risk,
I see.
huge potential. But when the market, I don't know, sneezes, these things can really take a hit.
Oh, I see. So it's not like ARKK is a bad ETF.
No, not necessarily.
It's more that, like, the style doesn't fit his philosophy.
Exactly. If you can stomach the volatility and you're true believer in all that disruptive innovation, then yeah, ARK might still be appealing.
Makes sense.
But for someone like Mark, it seems he's more about that balanced, consistent kind of approach, right?
You're right.
So yeah, understandable why it's at the bottom of his list.
Okay, so moving on, we've got his number 4 pick, JP Morgan Equity Premium Income ETF.
Now we're talking.
EAPI. This one's all about income using covered calls.
Interesting.
Now, I know some of our listeners might not be options experts.
Okay, yeah.
So can you break down how that works and
Yes.
why it appeals to certain investors?
You got it. So think of covered calls like renting out a room in your house.
Okay.
You own the house.
You own the stock.
Yeah, but you're giving someone else the right to use it
Right.
for a fee. And in this case, you own the stock, and you're giving someone the right to buy it from you at a certain price by a certain date, right?
Okay.
So if the stock stays below that price, you keep the fee.
You keep the premium and the stock.
Yeah, and the stock. But here's the catch. If the price goes up, you might have to sell, meaning you miss out on those potential gains.
So it's like trading some upside potential for a steady stream of income?
Yeah, I got it. That's why it's so appealing to certain investors. They're not chasing the big wins. They want that consistent income. Makes sense, right?
It does. So how has JEPI actually performed then?
Well, over the past year, it's returned about, I think it was 5%.
Okay.
But to put that in perspective, the S&P 500 gained nearly 25% in that same time.
Wow. So there's definitely that trade-off?
Yeah, you get that income,
Yeah.
but you might lag behind if the market's booming.
Okay. All right. Next up is, well, this one's interesting. The Vanguard Information Technology ETF,
Okay.
VGT. Now, Mark used to hold this one,
Uh-huh.
but decided to sell it.
Interesting.
Now, I'm curious, why would someone ditch an ETF that's all about tech? I mean,
Yeah, especially lately, right?
tech has been on fire, right?
Yeah, that's true. Well, see, VGT it's very broad. It covers the entire tech sector, so it's benefited from the growth,
Right.
but it doesn't necessarily target the most explosive areas.
Oh, I see.
And remember, Mark, he's all about steady, consistent growth.
Oh, yeah, you're right.
So maybe he decided to focus on something more specific.
He wanted to be more selective.
Exactly. Like instead of the whole net, he's
Yeah.
looking for, I don't know, a spear. Something more targeted.
Yeah, that makes sense.
And it's worth noting, VGT has actually had like a nearly 100% gain since the start of 2023.
Wow.
So might not be for Mark anymore.
Yeah,
But clearly the tech sector still has that,
that power.
the incredible potential.
All right, let's move on to the top 2 contenders in Mark's ranking.
Okay, the best of the best.
Starting with the Schwab U.S. Dividend Equity ETF, or SCHD.
I've heard good things about that one.
Yeah, it's like a solid, diversified, dividend-focused ETF,
Mhm.
really low fees, just 0.06%,
Wow.
and a history of consistent dividend growth. So
That's pretty good.
I'm curious, why isn't this one his number one with all those great features?
Well, that's a great question.
Yeah.
I think SCHD's performance has lagged behind the broader market, in recent years.
Really?
Yeah, and I think it's probably because it doesn't have a lot of tech exposure.
I see.
It leans more towards like healthcare and consumer staples.
So even though it's good,
Yeah.
it's not going to capture the same level of growth.
Right, not during these times at least.
That makes sense.
It's all about finding the right ETF for you.
Right. Okay, and now for the moment we've all been waiting for.
Drum roll.
Mark's absolute favorite. The Invesco QQQ Trust.
Oh, QQQ.
Yeah, or QQQ as it's better known. This one tracks the NASDAQ 100 index, so.
Lots of tech in there.
Yeah, heavily weighted towards technology, but it's got companies from other sectors too.
Right.
What makes this one stand out as his top pick?
Well, for one, QQQ is like considered a good proxy for the whole tech sector. It's got those big players, Apple, Microsoft, Amazon.
Right.
And it's done pretty well. Strong performer over the past year, 24% gain.
But we already talked about VGT, which is also tech-focused.
Right.
Why would someone choose QQQ over that?
Good point. So QQQ, it offers a slightly different flavor of tech, you see.
Oh.
VGT tracks a broad index, but QQQ follows the NASDAQ 100, which tends to be more growth-oriented.
Interesting.
And remember how we talked about diversification?
Yeah.
Well, QQQ has that. Includes companies from other sectors, too.
Oh, I see.
Which is a nice bonus. And you remember earlier we mentioned liquidity.
Ah, yes.
That's important for Mark.
Yeah, because he trades options, right?
Exactly. QQQ is known for its high liquidity.
So he can easily buy or sell without impacting the price.
Exactly. It's like having a sports car, nimble, you could zip around.
Versus like an SUV, a steady ride.
Yeah, exactly.
Okay, so we've got 5 very different ETFs here.
Yeah, quite a range.
The high risk, high reward ARKK, the income focused JPI,
Yeah.
the broad tech exposure of VGT,
Mm-hmm.
the steady dividend growth of SCHD,
Okay.
and the tech heavy but diversified QQQ.
Right. Lots to think about.
Before we dive deeper, what stands out to you so far?
Ooh, that's a tough one.
Maybe surprises? Lingering questions?
Yeah, actually, it's fascinating, isn't it? How his, personal preferences, like that whole liquidity thing for options trading,
Yeah.
really influences his choices.
Yeah, it's a good reminder that we all have different, styles,
Exactly. Understanding your own style and goals is, crucial, right?
Absolutely. So, speaking of understanding, let's dig a little deeper
Right,
into what makes these ETFs tick, right?
Yep, do it.
We've talked about the broad strategies, but
Yeah.
what about the specific companies driving their performance?
Now we're getting to the heart of it,
Yeah.
right? The companies themselves.
Okay, so let's revisit ARKK, that, high risk, high reward ETF.
It's a roller coaster.
Yeah, it's dominated by companies like, well, we mentioned Tesla, Roku,
Mm-hmm.
Teladoc Health.
Okay, so yeah, big emphasis on tech and innovative healthcare.
Yeah, definitely fitting that disruptive innovation theme.
For sure.
But wouldn't that also mean the ETF is heavily reliant on just those few companies?
You're absolutely right. That concentration in a handful of holdings, that's a big part of its volatility.
Oh, I see.
Like Tesla, for example.
Yeah.
It's been a major driver, both up and down.
Makes sense.
It's a good lesson,
Yeah.
When you're evaluating an ETF,
Yeah.
don't just look at the name and strategy right here. You got to look deeper, at the top holdings, understand where those risks and rewards are.
So for someone who, maybe isn't so comfortable with that level of concentration risk,
Right.
JEPI, with its covered call strategy, might be more appealing.
Could be.
So what are some of the key companies in its portfolio?
All right, so JPI's top holdings, we've got Microsoft, JP Morgan Chase, and
Okay, familiar names.
AbbVie. So it's a much more diversified mix.
Yeah.
Right?
Compared to ARK, for sure.
Yeah. And it's interesting, right? Because even though it uses those covered calls for income,
Yeah.
the underlying holdings, there's still those blue chip companies.
Oh, I see.
So less volatile.
So it's like a safety net while still earning that extra income.
Exactly.
Now, VGT, that broad technology ETF,
Yeah, BGT, I like that one.
includes some familiar names too, right?
Oh, yeah, for sure. You got your Apple, Microsoft, NVIDIA, all the big players.
Okay, so
That's what makes it attractive, right?
Yeah.
If you believe in tech,
Yeah.
but don't want to pick and choose individual companies.
Right. You just want that broad exposure.
Exactly.
And it's probably less susceptible to those wild swings we see in ARKK, right?
Yeah, because it's so diversified within tech.
Yeah.
Those individual company ups and downs, they kind of even out.
All right, let's move on to those top 2 ETFs on Mark's list,
Okay.
starting with SCHD.
The dividend one.
Yeah, what are some of the companies making it up?
SCHD, they're all about those solid dividend payers, right?
Yeah.
So in the top holdings, you'll find like PepsiCo, Broadcom, and Texas Instruments.
Okay, solid company.
Well-established, history of those consistent payments.
So a bit more slow and steady compared to, well, ARK especially.
Exactly. Different strokes, right?
Right. And finally, QQQ, the favorite, tech-heavy but diversified.
Yeah.
What companies make it the top pick?
All right. So QQQ tracks the NASDAQ 100, right?
Okay.
So you'll find a lot of the same tech giants as in VGT, but there's also companies like PepsiCo and Costco.
Oh, interesting.
So it's tech-focused, but not exclusively.
Right. That probably contributes to its appeal for Mark.
Probably, yeah. He seems to like that diversification.
He does. Okay, so speaking of diversification, let's zoom out a bit from the individual companies.
Yeah.
And look at another important aspect. Fees.
Ah, yes, the fine print.
Mark mentioned that he avoids ETFs with expense ratios higher than 0.5%.
Okay.
Now, a lot of our listeners have probably heard of expense ratios, but
Yeah, it can be a bit confusing.
it can be. Can you explain what they are and why they matter?
Sure. It's like a small leak in your boat, Might not seem like much at first, but eventually sinks you.
Oh, wow.
Right? So an expense ratio is the annual fee you pay for owning an ETF.
Okay.
Covers the fund's operating expenses, administrative costs, management fees, all that.
Mm-hmm.
And these fees, they're taken out of your returns.
Oh, I see.
So higher expense ratio, less money in your pocket over time.
So Mark's being mindful of those long-term costs.
Exactly.
Okay, so let's look at our 5 ETFs then.
Yeah, let's compare.
What are their expense ratios?
All right, starting with ARKK, it's got an expense ratio of 0.75%.
Okay.
Now, remember, it's actively managed.
Right?
So they're constantly buying and selling, trying to beat the market.
Which comes at a price.
It does. You're paying for that active management.
What about JPI?
JPI, also actively managed, with that covered call strategy.
Right.
But its expense ratio is lower. It's 0.35%.
Interesting. So even within the same management style, there can be differences.
Absolutely.
Okay. What about VGT?
VGT, much lower, only 0.10%.
Wow, that's quite a difference.
Yeah. And that's because it's passively managed. See?
Right.
It just tracks an index, not a lot of overhead, no fancy trading.
So passive management generally means lower fees.
Yeah, generally, yeah.
Okay, now SCHD.
SCHD, get this, it's got an expense ratio of 0.06%.
Wow, that's practically nothing.
Right.
Why so low?
Well, it's passively managed like VGT, but it also benefits from what's called economies of scale.
Oh, okay.
As more people invest, the cost per share goes down.
I see. So for investors who are really cost conscious, SCHD is a good option.
It is, yeah.
And finally, QQQ.
QQQ's expense ratio is 0.20%.
Okay, still relatively low.
Yeah, passively managed, tracks a popular index. That all helps keep costs down.
Okay, so we've got a range here from 0.06% to 0.75%.
Quite a spread.
Small differences can add up over time, right?
They do, especially long term.
But before we get too far ahead, I'm curious, what are your initial thoughts on all this? Well, any surprises with the expense ratios?
I think, yeah, it's a good reminder to, look under the hood.
Yeah.
Don't just assume.
Right, exactly. Okay, so we've looked at companies, strategies, and fees.
It's trifecta.
Yeah, but now let's talk about performance.
The bottom line.
Right. Mark shared some interesting numbers about returns. What stood out to you?
Well, ARKK's, what a ride, right?
Yeah.
Up over 205%, then down nearly 60%.
Like a roller coaster.
It is.
Yeah.
Definitely not for everyone. You got to have that.
That risk tolerance.
Yeah. That strong stomach.
Okay, what about GPI's performance? Has it been able to keep up with the market?
Well, remember, it's designed for income.
Right.
So over the past year, it returned about 5%.
Okay.
But the S&P 500, that gained almost 25%.
Wow, so there's definitely that trade-off then.
Yeah, income versus growth potential.
Like steady climb versus potential for big jumps, but also big drops.
Exactly.
Okay, VGT, the tech ETF, it's
been riding that tech wave, hasn't it?
Oh, yeah.
Nearly 100% gain since the start of 2023.
Incredible.
Shows that long-term potential, even with some bumps along the way.
So VGT, it's more about the overall tech trend, while ARKK is tied to those specific companies, those disruptors.
Right, makes sense.
Okay. How about SCHD, the dividend-focused one?
Well, it's had respectable returns, but as we mentioned, it has lagged behind.
Yeah.
Probably because of that limited tech exposure.
Right. Sector allocation matters.
It really does.
And finally, QQQ, the top pick.
The winner.
Its performance, it seems to fit Mark's style.
Yeah, it does. Gained about 24% over the past year, outperforming the S&P 500 and SCHD.
Makes sense with its focus on the NASDAQ 100.
Right, that growth orientation.
Okay, so we've seen how these ETFs have performed, each with its own, personality, risk profile. It's always good to keep in mind those broader market trends too, right? It's not happening in a vacuum, right?
Yeah, not at all. Market cycles, interest rates, even global events, it all plays a role.
Remember ARK's crazy run during the pandemic?
Oh, yeah.
That was driven by those stay-at-home trends, which have obviously
things
changed a lot.
Context is key.
It is. All right, as we wrap up this deep dive, what stood out to you most? Any surprises? Anything that piqued your interest?
Yeah, I think it's amazing how, different goals and preferences can lead to such different choices.
Yeah.
Really highlights that there's no one right answer, right?
Absolutely. It's all about finding the right fit for you.
Exactly. So as you think about your own investment journey and what's happening in the market right now, which ETF, which one sparks your curiosity? Which one do you think might be worth a deeper look?
Great question. And that's it for today's deep dive. Thanks for joining us, everyone, and we'll catch you next time for another deep dive into the world of investing.